What's going on, guys? This is Lior and welcome back to my channel. Now in this video, what I thought I would do is talk about the two high-level structures you can potentially invest your money passively in real estate deals. So what I'm going to talk about is the structure of lending and investing your cash as equity into deals versus lending your money as debt into different types of deals. We'll talk about the pros and cons of each, how they're structured, and which decision makes the most amount of sense for you if you're someone that has extra capital that needs to be put to work. So with that, let's get at it. What's going on, guys? My name is Lior and welcome back to my channel. Now, before I get into the meat and potatoes of the video, two super quick things, guys. Number one, if this is your first time on my channel, first of all, welcome. My name's Lior. I'm a multifamily investor based here out of Boston. And if you guys are looking for content about multifamily investing, renovations, tax strategies, investing strategies, this is the channel for you. Make sure to subscribe. And number two, guys, if you are someone that has some capital and you want to invest in multifamily and real estate, but you don't necessarily want to do all the grind and daily work of actually managing the portfolio, hit me and my team up, set up a call using the link below. So many of you guys reach out to us and we could talk about whether investing in some of our passive opportunities in multifamily deals can be the right investment move for you. So with that, now let's get right into it. And as I said, right, generally at a very high level, there are two different ways you, as someone that's got some capital sitting, can either invest or lend into someone else's deal. You can invest as an equity partner, right, where you're essentially becoming a part owner of that deal, or you can lend private debt. So let's start first with option number one, right? And we'll talk about what does it actually mean to invest in a deal as equity, right? So when you're investing into someone else's deal as equity, what it means is you are literally getting a percent ownership of the deal, right? You are becoming a part owner. Now, what are the advantages of becoming a part owner? Well, as a part owner of the deal, you're going to be entitled to cash flow distributions that come off the deal. Right? So if the deal is producing a certain amount of cash flow, you can get your pro rata share, right? Your percentage share of that cash flow because you are a part owner. Now, we won't talk about all the complexities about stuff like additional stuff like preferred returns. If you're interested in that, I've got plenty of videos on this channel, but there's basically ways where you can even get higher cash flows and distributions as a passive investor. Now, as an equity owner as well, the other advantage of being an equity owner is you, of course, get some exposure to the sale proceeds, right? So, you know, if you're investing in deals that are value add, right, where you can kind of fix up the property, improve the value, or if you're investing into a really strong market that's going to grow over the next couple of years, and when the property sells, there's actually profit made, as an equity owner, you're entitled to a percentage of those proceeds, right? So that's obviously going to be really huge, right? Because you're going to get exposure to the profits of the sale. And of course, that means you can get additional returns. Another thing to consider as an owner is the tax side, right? I've done a couple of videos specifically about the tax side for equity owners, but basically you get stuff like depreciation, you can take losses, which can help you mitigate against tax liabilities from other income sources you may have. Now, of course, those are the advantages. The disadvantages of lending equity is, you know, they're certainly riskier, right? I mean, you are not guaranteed a return as an equity owner, right? Because you are an owner, right? There's no guarantees in real estate. So as an owner, you know, of course, if you guys execute and everything goes well and you get the proceeds, fantastic, you're going to do really well. But of course, the flip side, of course, is, you know, if you don't do well, if the property doesn't execute or something goes wrong, then your equity can certainly be at stake and you can certainly potentially take losses. And again, your investment is not guaranteed as an equity owner. So that's kind of the high level of the equity lending side. On the debt lending side, usually the people I see gravitate towards this are people that are really focused on higher cash flows and risk mitigation, right? Because as a debt lender, right, you don't have that equity ownership, right? So you're essentially kind of like a bank to that investor that you're lending to, right? So there is going to be some sort of guarantee. Now, of course, there's different structures, and it depends, is that investor taking a first position loan with a bank or a hard money loan, and then are you coming in second, right? So the pecking order certainly can depend, But typically as debt, right, you are much more higher up the guarantee ladder than as an equity investor. On the debt side, the way I usually see people lending on it is really not as much on like the long-term multifamily holds, but rather they typically, these investors typically find like a fix and flip operator, and they lend money to the fix and flip guys as debt. So here's how that works, right? Let's say a fix and flip operator, is gonna buy a property. Let's say he's gonna take a hard money loan that is 80% acquisition and 100% construction. That flipper needs that 20% down payment plus maybe some soft costs. So you as a debt lender are gonna lend that money to the fix and flip operator. Now, typically these contracts are structured on a much shorter time scale, right? So whereas investing in multifamily as an equity owner, you're typically talking about a multi-year process. On the debt side, because this is a fix and flip, it's an in and out, right? So typically these contracts are for 6 to 12 months, right? Because the fix and flip person is gonna go in, renovate, and sell, right? As soon as possible. So you're typically looking at 6 to 12 timelines, maybe 18 if it's a larger project, but it's a much quicker turnaround. And then the way that the returns are typically stacked out, what I see typically in the marketplace is you as the private lender can get paid anywhere from 9-ish to maybe 14, 15% on your cash, right? And the way, again, typically what I see, I mean, there's no hard rule, but typically what I've seen is the way these contracts are structured is you would do like an interest-only loan, right? So if I lent a fix and flip operator $100,000 at 15% for 12 months, basically that fix and flip operator is gonna owe me $15,000 in interest. Those are going to be fixed payments, either monthly, quarterly, maybe they're all due at the end, depending on how you structure it. But that's typically how it's done, right? It's interest-only loans with the principal payback at the very end of the term. So as you can see, the advantage of lending debt to potential fix and flip operators is you can get very, very high cash-on-cash returns, right? I mean, you're getting 9 to 15% cash-on-cash returns, which is much, much higher than most multifamily syndication opportunities where you're coming in as an equity partner. The average cash flow on those tends to be, somewhere in the vicinity of 5, 6 to 7, 8%. So you can get certainly a couple of points higher. So if you're someone that's prioritizing, I want like a solid income stream, this could be a great opportunity. But some of the things you need to keep in mind is you don't get that equity upside, right? Because remember, you are a debt lender, so you don't have any ownership in the deal. You're just purely collecting your agreed upon payments. And then there's also no tax benefits, right? Because again, you're not an owner. You don't get anything like depreciation or any other sort of losses that you can use to offset your income. So this is typically good for people that want to create some cash flow, within their investment portfolio, higher than what they might get otherwise in a multifamily syndication. So those are the two options. Again, you can kind of see the differences, right? One is short-term, less risk, right? Because you're not an owner. You kind of get your guaranteed cash flow payments, so it's great for those people. But the other, on the equity side, if you're someone that's looking for longer term with more upside and some cash flow, you want tax benefits, right? Then the equity side can be a great, great place to invest. So both are good. It just depends on what your investment targets are and what you're looking to do in your portfolio. So hopefully that makes sense, guys. Of course, if you have any questions about this, make sure you put them in the comments below and I will definitely help you out.